Good morning, everyone, and welcome to Understanding the Tax Cuts and Jobs Act. I'm Vinny Civitello, Communications Manager for the New Jersey Business and Industry Association. With us today is Robert Schwartz of Lyndaberry, McCormick, Estabrook, and Cooper, PC. A few housekeeping matters before we get started. Today's webinar is being recorded and will be emailed to you tomorrow along with the PowerPoint for today's presentation, so be on the lookout for those. If you can't wait for that email, you can download the PowerPoint right now in the Handouts tab of your GoToWebinar panel, along with an article Robert wrote that he'd like you to read when you get a chance. I'd also like to draw your attention to the Questions tab. Robert would be happy to take all of your questions, so don't hesitate to write them in as they come to you. So now let's get things started. Robert?
As Vinny mentioned, my name is Robert Schwartz of the law firm of Lyndaberry, McCormick, Estabrook, and Cooper, with offices in Westfield, Summit, and Red Bank. Our firm was founded in 1954 in the city of Elizabeth. I'm going to begin today by describing the more far-reaching business income tax reducing provisions of the Tax Cuts and Jobs Act. These income tax reducing provisions are relevant to businesses whether they are paying the federal corporate income tax, which I will refer to as C corporations or C corporation businesses, or businesses operated as proprietorships, S corporations, limited liability companies, or partnerships, which I will refer to as pass-throughs or pass-through businesses, because the tax liability passes through to the business owners. You will notice on the slides code sections I will go through that have far-reaching effects on businesses. There are other Act provisions potentially reducing federal business taxation, but they can't all be covered today. For tax years 2018 through 2022, the Act amends Code Section 168K. Section 168K is part of the tax depreciation provisions of the code. It was changed by the Act to allow for 100% deduction of the cost of new or used tangible personal property placed in service by the business during any of the years 2018 through 2022. This 100% deduction declines pro rata for such property placed in service during one or more of the years 2023 through 2026. The immediate deductibility begins at 80% for 2023 and then reduces proportionally 60, 40, 20% for 2026. The remainder of the cost is depreciated over time in accordance with the long-standing federal tax depreciation tables. This 100% deduction is designed to induce business owners to make capital equipment and similar purchases that presumably will increase businesses' productivity rates. Increasing business productivity rates is considered by many members of the Federal Reserve Board and most economists as a means by which U.S. gross domestic product can grow at a healthy per annum rate without inflationary pressures. Consequently, this very beneficial tax law change is a paradigmatic example of an intentional federal fiscal policy. Immediate expensing of business property purchases has been on many drawing boards in Washington, D.C. since at least 1981, but only now is it the tax law and for a temporary period unless extended. Concerning C corporations, the businesses that pay corporate income taxes, the tax rate has been reduced from 35% to 21% indefinitely, beginning with a given C corporation's first corporate tax year beginning on or after January 1, 2018. Publicly available charts and graphs place this new U.S. federal 21% corporate income tax rate in the middle of the pack of developed nations' corporate income tax rates when an average of U.S. state corporate tax rates is factored in to the equations. This remarkable reduction in the federal corporate tax rate from 35 to 21% was not thought possible by anyone as recently as a year and a half ago. Also concerning C corporations, the corporate alternative minimum tax is repealed indefinitely, beginning with a given C corporation's first corporate tax year beginning on or after January 1, 2018. Now concerning pass-through businesses. They're the businesses that do not pay the corporate income tax. The business owners pay the taxes on the business income. For tax years 2018 through 2025, qualifying owners of qualifying pass-through businesses are allowed a tax deduction, which is initially best thought of as equal to 20% of X. This 20% of X income tax deduction is found in new Internal Revenue Code section 199 Cap A. 199 Cap A. A 20% of something deduction is a big item. The technical trick, the knowledge you need, concerns calculating or figuring out 20% of X. A broader consideration is whether a given pass-through business would have more after-tax income by converting to a C corporation with a 21% federal tax rate, or whether the Section 199A deduction is more income tax efficient for business owners. I will speak in detail about this comparative consideration in the last segment of this program. The main point of Section 199A is reducing personal federal income taxes on owners of trades or businesses operating in the form of a pass-through. As mentioned earlier, a pass-through is an S corporation, limited liability company, any kind of a partnership, a proprietorship, and any other trade or business entities beyond these that is not IRS tax classified as an association taxable as a C corporation. The Section 199A deduction is not available to C corporations. It's not available to owners of C corporations, and it's not available to C corporations that have ownership of pass-through businesses. In the case of pass-through entities that own interests in other pass-through entities, the Section 199A deduction tiers up to the ultimate individual, or less commonly in practice but permissible, estate or trust business owners. Consequently, the overwhelming majority of applications of the Section 199A deduction will be at the individual level in the context of a joint or separately filed IRS Form 1040. In these typical contexts, the Section 199A deduction can be conceptualized as the last deduction from taxable income when the individual or joint filer is preparing their taxes, computing from gross income down to taxable income, to which the applicable tax bracket rate then applies. Everyone should be aware that the Section 199A deduction is a use or lose deduction, in the sense that it is only available to reduce a business owner's taxable income for the year the single or joint Form 1040 is filed, and only when the return reflects taxable income before the Section 199A deduction is then taken into account. There is no carry forward of an unutilizable Section 199A deduction. Example 1 illustrates the Section 199A deduction. If one grasps a basic example, then one has the fundamentals for understanding Section 199A's operation in other situations. I hypothesize one Luther. Luther is a luthier. Luther makes mandolins, Luther makes dulcimers, and Luther repairs stringed instruments, including dulcimers, including mandolins, as well as guitars and banjos. For 2018, Luther's business generated $90,000 of gross income. He also had to pay third-party business expenses. That is to say, he had to pay business expenses before he paid himself of $60,000, leaving the business with $30,000, and the term of art is qualified business income. Now notice Luther operates through an S corporation, and he's the sole stockholder and the sole employee. Consequently, Luther has to pay himself wages because the federal government expects to collect employment taxes. Luther pays himself $15,000. His tax attorney or his accountant advises him that $15,000 constitutes reasonable compensation. That's an important figure because the amount of wages a pass-through business pays, whether to owners or to others who work in the business, factors in to the calculation of the Section 199A deduction. Now, the Section 199A deduction involves a complex calculation, which is why I refer to it as a deduction equal to 20% of X. Looking at the left-hand side of example 1, you'll notice the deductible amount. What follows below is an accurate calculation of the deductible amount. You find out here that the deductible amount is $6,000. However, the way the Tax Act is written, that's not the deduction. In order to arrive at the deduction, you have to go further with the calculation. The further step then is to ascertain what's known as combined qualified business income amount, CQBIA. Under Section 199A, the combined qualified business income amount equals the $6,000 determined above plus the other computational factor amount, which in this case is $7,500, for a total of $13,500. Now, I'm going to skip over the nuance of the $157,500 taxable income threshold, because I want to keep you all focused on the fundamental calculation as an example. So we've gotten so far as to have calculated the combined qualified business income amount. So we move to the next, which is the allowed as a deduction amount. This is the true deduction. What does it consist of? It consists of the lesser of the CQBIA or 20% of Luther's $18,000 pre-Section 199A taxable income. Well, if you look on the right side, we can see the way in which one arrives at Luther's taxable income for purposes of applying this new deduction. Because he's the business owner, before he pays himself, the S corporation generated $30,000 of income. His wages were $15,000. That's a deduction from S corporation income, arriving at S corporation income that goes on Luther's Form 1040 of $15,000. Now that's before the deduction. He then gets the deduction. The deduction is 20% of his $30,000 of income. Why does he have $30,000 of income? 15 wages, 15 income passing through from the S corporation as net business income. Also, because the Section 199A deduction is the last deduction, Luther, if he's eligible, first takes other deductions. Here, I hypothesize Luther takes the standard deduction, which is now $12,000. Consequently, you're applying Section 199, 20% to a base taxable income of $18,000. That equals $3,600, thereby reducing Luther's taxable income to $11,400, which drives his tax down to $1,537 on $30,000 of net income from the business. This dramatic result was intended by Congress. Whatever may be the unintended aspects of Section 199A, you may have come across in the popular media or trade publications or told about by others. A much written aspect of Section 199A concerns the kinds of trades or businesses whose owners are eligible for the deduction. In other words, what is a qualifying trade or business? There are two important aspects to consider. The first concerns the concepts that owners of businesses in the following fields must have taxable incomes below specified threshold amounts, depending upon whether the business owner is filing a single or joint Form 1040 for the tax year in question. The first concerns the concept that owners of businesses in the following fields must have taxable incomes below specified threshold amounts in order to be eligible for the Section 199A deduction. In shorthand, these are skill/reputation service businesses. The following fields have been specified into legislation: medicine, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, investment management, and trading or dealing in securities, in partnership interests, and/or commodities. A catch-all definition is as follows. This is important enough to quote. Any other trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. However, expressly excluded in the legislation at the last minute are the trades or businesses of professional engineering and architecture. To paint with a broad brush, a surgical group whose owner surgeons conduct business through an S corporation or a limited liability company, and who are each making a minimum of $415,000 of taxable income before the Section 199A deduction, are not eligible for the Section 199A deduction. By contrast, the owners of a New Jersey concrete company who conduct business through an S corporation or a limited liability company are going to be eligible for the Section 199A deduction with no taxable income limits. Owners of service businesses in the skill reputation fields whose taxable incomes do not exceed $157,500 in the case of a single filing joint 1040, or $315,000 of taxable income reflected on a joint Form 1040, can claim a full Section 199A deduction just as if they had ownership interest in non-service businesses that are not subject to this eligibility limitation. In addition, a reduced amount of deduction is available for reputation skill service business owners if, in the case of single return filing, taxable income does not exceed $207,500, and in the case of a joint return filing, which of course would include the spouse's taxable income if both spouses work, taxable income does not exceed $415,000. The reduction of the deduction is not a cliff, but rather it is a proportional phase out of the amount of the deduction as taxable income reaches the upper limit. For qualifying business owners, including skill reputation service business owners who have taxable incomes below the upper limit for the phase out of the deduction, I expect the IRS will create either a new special tax form or add to the well-established Schedule K-1 at least 3 essential line items: the business owner's share of qualified business income, the W-2 wages paid by the business to all employees, and the unadjusted cost basis of tangible, depreciable property used in the business at the end of the year and which has been in service for not more than the greater of 10 years or the last day of the last full year of the Section 168, depreciation recovery period for the property in question. That's a mouthful. what I'm trying to get at here is when you do the 199A computation as I illustrated, and you go through the step of ascertaining the deductible amount, which is not the actual deduction, you'll find that the amount of depreciable property that the business had purchased and it's still in use in the business, 2.5% of the original cost of all that property, whether you bought it 5 years ago or you bought it last year, it's still in use. 2.5% of the original cost of all that property factors in to the amount of the Section 199A deduction. And to get way beyond the scope of a limited presentation of this nature, it may turn out to be an academic calculation in terms of how much deduction does the business owner get, no matter how much of original cost basis of depreciable property the business owns. It may turn out to be an academic calculation. Nevertheless, it's a calculation step that if you take, you're not going to get the calculation wrong, or your accountant's not, or the computer program your accountant buys is not going to get it wrong. One final point about the business property cost that factors in a 199A deduction. The formulation applies to the property first used in the business both before and after January 1, 2018. That makes life a lot simpler. I'm now going to move on to a section of the Act that focuses on business losses. Because Congress recognized businesses sometimes experience a net loss for a year, and for reasons unknown, the Act introduces new Section 461L, directed to situations where pass-through business owners share in a business operating loss for the year. Section 161L limits, it reduces the tax deduction for net business loss that pre-act was not limited for business owners who were active in their businesses. Section 461L business loss use limitation applies to S corporation shareholders and also to other pass-through entity or proprietorships, nearly all of which are going to be individuals in a relatively few estates and trusts. Section 461L does not apply to C corporations, and apparently not to S corporations to the extent that they pay corporate level taxes, as they sometimes do. In addition, new Section 461L applies after the application of the by well-known Section 469 passive activity loss deduction limitation. Thus, for inactive business owners, these long in place PAL, they're your PALs. The long in place Section 469 PAL rules continue to operate to often bar loss deductions for inactive business owners. For active business owners whose business loss shares do not rise to the level of a Section 461L excess business loss, the business loss can be used against other taxable income for the year, if any. If a business operating loss share is all or partly unusable by the owner because of insufficient taxable income from other sources, or on account of the calculation shows an excess amount of business loss, the unused losses can be carried forward to later years as part of the historic Section 172 net operating loss deduction for those later years. If one grasps a basic example of the excess business loss calculation in an active owner context, then one has the fundamentals for understanding its operation in other situations. I hypothesize Luther the luthier, who is the sole stockholder of an S corporation. In this example, Luther's business has grown successfully, and the corporation employs several persons besides Luther. The 2018 gross income of the business was $1,900,000. The third-party business expenses, including the payroll for company employees, not including Luther, was $2,650,000. Consequently, Luther's S Corporation had a $750,000 business tax loss for the year. Now, that's a common occurrence for all those of you who have been in business for any period of time. It was a bad year, or maybe it was a good year gross income-wise, but there occurred extraordinary expenses that turned out to be deductible, and as a consequence, there was a business loss for the year. Now, Luther, again, has to pay himself wages. In this instance, given the size of the company and other factors, a reasonable amount of compensation for Luther is $300,000. That, too, is a deduction when one owns an S corporation at the corporate level. Consequently, the business tax loss for the year is $1,050,000. Now, I decided to illustrate in this example too the Section 199A deduction just for the heck of it, and it also allows one to see how the calculation works in another numerical fact pattern. There wasn't any taxable income. There wasn't any qualified business income for the year. There was a business tax loss instead. So in the absence of the qualified business income, there's no Section 199A deduction. Now, if you look at the lower right of example 2, you're going to see how Section 461L computation works. The statute says you compare the aggregate business deductions. So they equal the third-party business expense plus Luther's wages. So that's $2,950,000. You look to the aggregate business income, which is the same way as saying the gross income, and then you add an amount. The amount's in the statute. There's an amount for a single 1040 filer, and there's an amount for a joint 1040 filer. For the single filer, Congress chose the amount of $250,000. That gets added to the income. Then you do the subtraction, and in this instance, $800,000 of the overall $1,050,000 business loss is an excess loss. So Luther can't claim that $800,000 against his $300,000 salary for 2018. If his wife works and she files a joint return and she made $200,000, he can't use the $800,000. But he can use $250,000 because that's the amount of the loss below the excess amount. Consequently, assuming Luther's not married, he files a single 1040. His taxable income for the year is $50,000. The rest of it gets carried forward along with the $800,000 to 2019, and whether or not the Luther will have a Section 172 net operating loss deduction for the next year depends on whether he has taxable income after the Section 199A deduction. Focusing now on the Section 172 net operating loss deduction, which again, it's a deduction that takes place in a later year. It's called the Section 172 net operating loss deduction on account of business losses in a prior year that were not available to reduce the business owner's taxable income, either because of new Section 461L or because the business owner didn't have any taxable income from other sources, so the tax return just showed a net loss. The Section 172 net operating loss deduction has long been in the code. It represents a carryover of unused business losses from prior years. So, for example, if a business had a $1 million operating loss for 1 year and the next succeeding year generated $1 million in taxable income, the taxpayer reduces business taxable income by the carryover of the loss. Complex rules beyond the scope of this program often mean the carryover loss is not a dollar-for-dollar tax deduction, reducing taxable income, but generally the Section 172 net operating loss deduction has been available to reduce substantial taxable income in later years, all other code sections being equal. The Act amends Section 172 to allow taxable income reduction by only up to 80% of what a later year's taxable income amounts to before claiming the deduction. This limitation to 80% of taxable income pre-Section 172 deduction is a significant change in the Internal Revenue Code, and it will begin to look like a minimum income tax to many business owners, including owners of C corporations, since this new 80% of taxable income limit also applies to C corporations as well as to pass-through business owners. The Act also provides that for losses arising in Section 2018 and later years, there's no carryback of losses to obtain a refund for prior years, except there is a 2-year carryback continuing indefinitely for farmers. The Act makes the carry forward period unlimited, as opposed to the 20-year carry forward limit in the Internal Revenue Code prior to the Act. I will now focus you on why a business might want to incorporate and become a C corporation or remain a pass-through business such as an S corporation. I have concluded that a review of up to 3 years or shorter period since business startup, annual gross revenues and deductions of a pass-through business taken together with a 2 to 3 year estimate of future annual gross revenues, together with projected business deductions, as restated, to reflect a normalization of deductible expenses, if normalization is warranted, serves as the appropriate factual baseline for making a decision concerning whether the business operates as a C corporation with the 21% federal corporate income tax rate or remains or becomes a pass-through business. I'm implying by these observations the determination is a business-by-business consideration. I will now go through examples. My first example concerns Luther, the luthier. And Luther's S Corporation business. In this example, Luther's S Corporation business is generating $290,000 of gross income. And it's incurring $120,000 of business expenses before wages. Now that calculates to $170,000 of qualified business income, which is our term of art under Section 199A deduction. On the left-hand side of the example, as I did in example 1, I walked you through the ascertainment of the deductible amount. I walk you through the computation of the amount allowed as a deduction. And in this instance, on the numbers present, the amount allowed as the deduction is $31,600. Turning over to the right side, which shows one how Luther utilizes that $31,600 deduction, I note that the business has qualified business income of $170,000. Luther's reasonable compensation for the year as an employee of his S Corporation is $120,000. Consequently, Luther has $50,000 of pre-Section 199A taxable income attributable to his being the owner of a pass-through business, and he has $120,000 of wages for a grand total of $170,000 of taxable income before deductions. Now, I'm hypothesizing here that Luther is a single filer, so he gets the $12,000 standard deduction. He then takes the $31,600 Section 199A deduction, and as a consequence of that, he pays $27,505 tax on $138,400 of income, which is a very favorable amount of tax compared to before the Section 199A deduction became part of the federal tax law. There's another aspect to this calculation that I haven't spoken of before, and that is the Tax Cuts and Jobs Act has lowered the individual income tax rates. I'm sure everyone listening to this program is aware of that. I doubt anyone listening to this program can tell me off the top of their head, what are the new tax brackets? Where do they begin? Where do they end? And what are the rates within the new 7 tax brackets? But I can generalize and say the rates have been lowered and the tax brackets at which lower rates apply have been expanded from smaller to bigger. So consequently, for owners of pass-through businesses, the Act provides for what amounts to tax reduction even without the Section 199A 20% of X deduction. Now, going back to this example 3A, I calculated Luther's employment taxes on the W-2 wages because for business owner workers, there's employment taxes. So I accurately calculated the employment taxes. We know what Luther's income taxes are. We could see the total tax of $45,865. Now let's go to example 3B, which is the comparison. In 3B, Luther revoked the S Corporation election, which this year means he did it before March 15th, I think. If I'm wrong about that, tell me. Let's say Luther timely elected the S Corporation election, so now his corporation pays corporate taxes. I have the same gross income, I have the same business expenses before Luther's wages. We have the same taxable amount. We have Luther's wages at $120,000. We come down to $50,000 of corporate taxable income. Now it's a C Corp. It's a separate taxpayer. It's not Luther paying the taxes on the business income. It's the corporation. We have the new 21% corporate income tax rate, no longer 35%. 21% of $50,000 equals $10,500. Now we have to look to Luther. He's the business owner. He had wages of $120,000. He claims the new standard deduction, and that comes down consequently to $20,209 of federal personal income tax on Luther. Luther also has employment taxes because he got wages. It's $120,000 of wages. It's the same employment taxes as in the case where Luther operated through an S corporation. So we have the total taxes of $18,360 federal employment tax, $10,500 corporate income tax on the business, and $20,000 plus a personal income tax for a grand total of $49,069 with the C corporation. Now that's in contrast to the $45,865,000 where Luther remained an S corporation. Why the difference? Well, conceptually why the difference is that after the Section 199A deduction, given Luther's business profile and his wage profile, he was personally paying at a lower effective federal individual income tax rate than the 21% corporate income tax rate. He was paying at a lower effective federal income tax rate than 21%. Why? Well, at this level of gross income, this level of deductions, this level of net income, you're in, the individual's in a lower tax bracket than 21% effectively. Now, if we look at the C corporation further, and for 2018, Luther had the corporation buy $50,000 of equipment. Remember earlier, I went through the fact that the Act allows immediate expensing for depreciable property, immediate 100% deduction up front, no spreading the deduction over the depreciable life of the equipment. So if Luther caused the C corporation to buy $50,000 of equipment, the corporate taxable income is zero. Recall also I mentioned there's no longer a corporate alternative minimum tax. Prior to the Act, there was a corporate alternative minimum tax. One would have had to go through the calculation in order to determine whether there's a corporate alternative minimum taxable income that would have been subject to a federal corporate tax rate. You don't have to do that anymore. The Congress repealed the nettlesome corporate alternative minimum tax. So you see, by buying the equipment, Luther reduced the C corporation's taxable income to zero. If he did that, then his total taxes for the year are $38,569 compared to $45,865 if he had remained an S corp. Yes, you're right. If Luther, still in an S corp mode, had caused the S corp to buy $50,000 worth of equipment, it would have reduced his personal taxes in the S corp business owner context such that the total tax would have been below the $38,569. But I wanted to illustrate this because 1 year is not enough to judge whether a business currently operated as a pass-through should convert over to a C corporation to take advantage of the low 21% corporate tax rate. You got to look at that situation and make that judgment over a longer time frame. That's why I mentioned projections. Now I've got another set of examples here that show the comparison at much higher levels of business gross revenue and deductions. And I'm going to do my best now to race through these examples. And let's see if you could keep up with me. Ready, set, go. In example 4A, I hypothesize Luther to Luthier, and he owns a single member LLC, okay, limited liability company. There's probably a lot of limited liability company owners out there. I'm hypothesizing here a single member limited liability company. Luther's a sole owner. And as such, given it's a Luthier business and he's not a surgeon, he's eligible for the Section 199A deduction in full. So I hypothesized the gross income of the business of $5,290,000. So Luther's business, it's continuing to grow. He had that loss year, but he recovered and things are going well. There's third-party business expenses, including his payroll, including his LLC's payroll. So the LLC's paying wages to non-owners. The consequence is a $1,470,000 of qualified business income. All right, you have to have qualified business income to start the Section 199 deduction calculation. On the left side, again, I work down through the computational mechanism through all these various paths of the logical tree. And I come down to a $291,600 Section 199A deduction for Luther on the basis of $1,470,000 of qualified business income. So that's a substantial deduction, and that's what Congress intended by enacting the the Tax Cuts and Jobs Act. All right, so on the right side, as usual, I work my way down Luther's personal 1040 tax return to see how the deduction impacts on his income. Now, in this example, it's a single member LLC. Business owners of LLCs don't get W-2 wages. Business owners of S-Corps do. But business owners of LLCs that work in a business, they don't get wages, which then goes on their tax return as wages. And then there's another line for their S-Corp business income, which is minus their wages and so forth. With an LLC or a partnership, the business owner's taxable income comes down to what the taxable income of the business owner was before the business owner pays himself any, whatever you want to call it, salary, remuneration, but it's not wages as such. I wanted to throw this twist in here because it's just how it is with limited liability companies compared to S-Corps. So anyway, Luther gets the full deduction. The deduction reduces his taxable income to $1,178,400. He takes the standard deduction, which every taxpayer gets if they're filing singly, and it results in $397,257 of taxes on $1,470,000 of business income. You could do the math and figure out what the effective rate is. Now let's go over to example 4B, where I hypothesize Luther merges his LLC into a pre-existing C corporation. That's another way of becoming a C corporation. You could merge the LLC into the C corporation, and then you have a C corporation for the business. I use the same numbers, so we're looking for consistency here because we're doing a comparative study. Consequently, there's $1,470,000 of what I call tentative corporate taxable income. Now, because we have a corporation, whether S or C, Luther's got to pay himself reasonable compensation. That wasn't a consideration where he was the owner of the LLC. So one of the factors when you're talking about switching from a pass-through to a C Corp to take advantage of 21% rate is you got to pay yourself reasonable compensation. However, that is going to be defined. And there are definitions of reasonable compensation through many tax court and other federal court decisions where the IRS and the business owner went to war over whether the amount of compensation paid to business owner was reasonable or not reasonable. All right, in this example, I hypothesized Luther's W-2 wages at $470,000. He's the sole owner of a business now generating as much as $5,300,000 of income for the year. And the business has obviously grown since the days when Luther's income was grossing $90,000. All right, so we go through the arithmetic here. And I do the arithmetic, direct your attention to the left side where I figured out the taxes on Luther's $470,000 of wages. Okay, he's got to pay the Social Security and Medicare taxes. Well, he's got income over the Medicare limit. So he's going to be paying the additional 2.9% on his 470 over 341,600. And then we've got another Medicare surtax here. This was part of the Affordable Health Care Act of 2010, otherwise known as Obamacare. This is the 0.9% Medicare surtax on taxable income wages over 270. You add up the employment taxes and go back to the right side and figure out the corporate taxes. Well, we know what the tentative corporate taxable income was. We know what Luther's wages are. You have $1 million of S Corp taxable income. You have a 21% corporate tax rate. We know what the corporate tax is. I figured out Luther's individual income taxes, not his employment taxes, but his income taxes on the $470,000 of wages. So I added up the total taxes and got $377,970. This is an exercise you can do for your own business, just the numbers change. Now, I put in the lower left the alternative of what if Luther had remained an LLC. For your convenience, the fruits of example 4 are here. So you could see in this example that if Luther had remained an LLC at this level of gross income, at this level of taxable income, at this level of wages, you'll see that Luther converting his business from a pass-through business to a C Corp reduced his taxes from $467,000 to $377,000. I say, well, why is that? Well, where Luther owns a business of this magnitude, where it's generating taxable income of $1.4 million, $1.5 million, $10 million, $100 million, he's in a higher tax bracket. And the business is he as a pass-through business owner is in a higher tax bracket. The new tax brackets run up to 37%, not up to 39.6, but up to 37%. So you have the larger business in terms of gross revenues, and therefore ordinarily in terms of taxable or net income, the business owners are going to be in higher tax brackets than the 21%. That's the principle, but not the only calculation factor or driver that goes into the comparative analysis you would want to make before you decided whether or not the business would be best or more tax efficiently operated as a C corporation. Now, the last example here we don't have time for. I call it example 4B continued. So it's example 4B continued. And what I did there was I said, all right, there's other taxes besides federal taxes. For those of you who might live in New York City, you're well aware of that. For those of you that live in New Jersey or in New York, outside of the city or outside of the metropolitan surtax on business zone, we all know there's such a thing as state taxes. And New Jersey has a full menu of taxes. So New Jersey has a gross income tax. New Jersey has a corporate tax. The personal income tax top rate currently at the maximum bracket is 9% for practically speaking. I think it's 8.87. The New Jersey corporate income tax, which is a separate tax if you're a C corporation, the business owner's corporation pays the New Jersey corporate income tax. That's 9%. If the New Jersey business owner operates through an S Corp, New Jersey S Corp, remember it's a separate election, or through a limited liability company, no tax election required. You have then the New Jersey resident business owner paying the New Jersey gross income tax on the business income. So this example, I spent a lot of time, doing the behind the scenes calculations. And I decided to hypothesize the same fact pattern as an example, 3B and 4B. So I said, well, okay, where you have the C corporation, where there's $1 million of taxable income. If Luther's operating through the LLC, because as the owner of the business, there's no wages for Luther in an LLC or partnership context, so the taxable income in that context is $1.4 million. And then I walk you through the New Jersey tax. For the C Corp, you have the 9% CBT. On the right side, well, the New Jersey gross income tax, I didn't show the brackets. I just did the calculation as you normally would for an individual New Jersey 1040. And so I come down to the business net income after state tax. I factor in the state tax deduction in computing the federal tax. And maybe I'd make an editorial comment here. I think everyone's aware that there's a $10,000 federal income tax deduction limitation on state taxes paid, whether they're income taxes, whether they're real property taxes, whether they're sales taxes. However, under the Act, there is a preservation of the deduction of state and local income taxes paid by a business. That's an important distinction. You're probably all aware of it, but you might be fuzzy about it. The state tax deduction on a business owner's federal income tax return for state taxes paid on business income, or if the business owns real estate and there's a property tax on the real estate, they're business taxes, and therefore they remain a deductible item for the business owner or for the business owner C corporation if that's a separate taxpayer as it would be. So anyway, I worked my way through the computation and I come down to the comparative taxes. If Luther had remained an LLC, $529,021, or if he converted over to an S Corp, $476,833. It looks like going to C Corp is more income tax efficient. And on these facts, it is. If similar fact pattern was to occur in later years, also if the business net income was going to go up in later years, the C corporation on an annual basis would be a more income tax efficient form of business entity for the Luthers of this world. Well, I've overshot my time. I thank you all very much for listening. Again, my name is Bob Schwartz of the well-established New Jersey law firm of Lindaberry, McCormick, Estabrook, and Cooper. Thanks for tuning in, everybody.
Well, I mean, that's the end of Robert's presentation, but we can stay on for Q&A as long as we have to. If you have to log out, I know we're hitting the lunch hour here. By all means, feel free to. Everybody who signed up today is going to get an email tomorrow with the video of this presentation. So if you missed the Q&A, you can always check it out at your convenience later. So thank you to Robert, and thank you to Luther Luthier, our fictional friend, for letting us pick through his income and his taxes. So we have a couple questions here already. I'm going to give everybody a second to type in anything they have. While I'm doing that, check out the handouts tab. That's where you can get the PowerPoint and an article that Robert wrote for you to read. Don't be shy. I love to say that. Don't be shy. We have an expert here that you can take advantage of. He'd love to answer your questions. So with that, our first question comes from Steve, who says, Could you touch on the international taxation aspects of the Section 199A deduction? What if a pass-through business sells to overseas customers?
Well, that's a very far-reaching question, Vinny. Let me say this. Section 199 was written to state that if a New Jersey-based business's income originates or arises from the business people here in New Jersey generating that income, not that the New Jersey-based company has an office in Brussels or has an office in Berlin, and those people are generating the sales income or generating the service income. But if the business income is being generated from a U.S. office location or from a U.S. factory location or a U.S. warehouse location of goods bought from anywhere in the world, and then they come to New Jersey, go in a warehouse. Some are shipped to California, some of them are shipped to Spain. If the income's being generated from a U.S. business location by U.S. employees, by U.S. business owners, then the income, the gross revenues of the business, and the business expenses related to the U.S. operation. So if there's two places of operation, New Jersey and Berlin, the business expenses related to the New Jersey office, the income connected with the U.S. office or factory, and the deductions related to that, they factor into the Section 199 deduction. So the short answer is the deductions available to pass-through business owners who sell overseas or provide services to overseas customers, as long as they're operating out of the U.S., as long as they're operating out of the U.S.
Cool. Raymond asks, do these examples ignore the effect of C Corp dividends?
Yes. Yes, these examples ignore the fact of C Corp dividends. C corporations is in my very last example, which is example 4B continued. We found out that at high levels of business gross revenues, deductions, the end result being significant profitability, we found out that the C corporation at the 21% rate is more income tax efficient for the business owner than a pass-through business entity or proprietorship because of the relative high 37% or 35% or 33% pre-Section 199 deduction for the individual business owner versus the 21% flat corporate rate for the C Corp. Now, if the C Corporation, it has profits, it could pay a dividend to the stockholders of the C Corporation. Well, that dividend's going to be taxed at different rates depending on the C Corporation shareholders' tax bracket. Now, if the only owner of the C Corporation is Luther and Luther's made $470,000 of wages, he's going to be in the 37% tax bracket. So his dividend is going to be taxed at the highest dividend rate, which is 20%. If Luther's salary were less, it were down below, I don't remember the top of the cutoff, but I think it might be something like $200,000 for a single filer. If Luther's personal taxable income, let's just use $200,000, were $1,999, he'd be in the 15% bracket on the dividend. If, let's say Luther's mother's name is Martha. If Luther's mother happens to be a stockholder in a company and her income for 2018 not counting before the dividend payment, say she owes 10% of the company. She has Social Security and she has some General Motors stock or some Mobile Exxon stock. She has dividends. Her taxable income before Luther's company pays her a dividend is, say, $50,000. She's in a 0% rate for dividends because her taxable income is below $77,000. So if you have C corporation shareholders, which of course you will, depending on which of the dividend rate tax brackets they're in, the tax on a dividend, federal tax on a dividend, could be 0 or 15% or 21%. If it's 21%, like it is in the case of Luther, if the C Corp paid out all its after corporate tax income to Luther, all of it, all 100% of its after corporate tax income to Luther, it did not invest in immediately deductible piece of equipment, reducing the corporate tax further. It just paid it all out to him. Luther would pay 20% on that dividend, federal. And then, of course, New Jersey would tax Luther under the gross income tax or whatever his tax bracket would be. So yes, you do have the double taxation with C corporation when the dividend's paid, but the income tax effects of it will greatly vary depending on each situation.
Cool. Actually, Robert earlier in the week wrote an article for our website on this very topic, and 2 questions came in online, so I wanted to pose those to you right now. So Kevin asks, or says, I am confused by the comment that moving to a C Corp from an S Corp with the Section 199A deduction could be more income tax efficient. Could you please talk about your comment to help me understand?
Okay, Kevin, I hope you were listening today, and if you were listening intently, you would now know the answer to your question. If not, feel free to give me a call. I'm a career tax attorney and corporate business attorney. My number is 908-233-6800, and again, my name's Robert Schwartz, or for people who know me, Bob.
Okay, the other one comes from Grant. Are there any explicit exceptions to the high skill or reputation service businesses exclusion that are definitely allowed to take advantage of the 20% tax rate?
Well, as we know from listening, I covered the specific reputation, skill, service business lines that if you're making too much money, you're not going to get the Section 199A deduction. If you're not making enough money, you are. And there's some people in the middle who are going to get a partial Section 199A deduction. So we covered those categories. But this question can also be construed as asking, what if it's not an enumerated line of work like medicine or law? What if it falls under that general catch-all definition that I quoted? What does that mean? What does that definition mean when you apply it to a particular line of work? I could give this example. I made the judgment that our Luther, the luthier, while he's certainly in a skilled business, you don't make mandolins unless you're very highly skilled in carpentry, etc. Also, you don't get enough sales to remain in business unless you have quite a reputation for instrument making. But I made the judgment that because he's in a business that involves a lot of machinery and equipment and would grow in the direction of machinery and equipment and plant. If you get up to the size of, say, a Martin Guitar Company in Bethlehem, you're going to have a substantial plant. And in enacting Section 199A, Congress wanted to put the major focus on businesses that would be buying a lot of plant property and equipment and that would be hiring a lot of people. If you're making musical instruments, you could go from a craftsman, one-off guy to a partner to another guy to breaking down the instrument manufacturer into parts you could add to your workforce. As far as all the other lines of business where somebody out there or somebody hears about this program or this issue scratching their head, no doubt the IRS is going to come out with some kind of further elaboration on the definition. In my opinion, there's no doubt they're going to come out with that before the end of this year. Now, that may satisfy, for example, the accounting community, or it may give rise to a hue and a cry because so many lines of businesses are being thrown into the limited or no deduction. I don't know. I can quote you from the Roman law. And quoting you from the Roman law may give you some idea of what the IRS may do when they further elaborate. Nasitu ceases. That means as those enumerated, so too the others. I hope that helps.
Very cool. Okay, so that looks like all the questions we have, so I think it's as good a time as any to bring things to a close. I want to thank everyone who stayed online with us after the 12 o'clock hour. We really appreciate it. Don't forget, all of you will be receiving a recording of today's webinar and the PowerPoint slides via email. Lastly, when you close out of the webinar, a survey will come up on your screen that we hope you'll fill out so we can understand how best to provide you important information in a webinar format. Our next webinar, NJBIA Live from the State Capitol, will take place tomorrow and will feature our very own Frank Robinson and Andrew Music talking about the budget. So by all means, feel free to register for that one right on our homepage, and we'll see you there. So until next time, for Robert Schwartz, this is Vinny Civitello thanking you for being with us this morning and wishing you a great day.